Yeah. I can't remember if I'm trying to go password. So I'll just put it on the presentation. I don't vote anyway.
There you go. Well, it didn't like me at first. Good morning and welcome to the Oklahoma City MAPS Investment and Operating Trust meeting for May 19th, 2025. We are called to order. First item of business is the approval of the minutes from the February 17th, 2025 OCMIOT meeting. They were included in your packet. Any amendments, corrections, changes? If not, I'd take a motion in a second. Please cast your votes. Motion passes. Moving on to items for consideration. 3A, receive the general manager report for the period ending March 31st, 2025. Matt, welcome. Good morning.
Good morning. How's everyone doing today?
Good.
Good. Good to hear. Well, this is somewhat of a calm before the storm report for us, looking at the March 31st report. I'm not going to touch really a lot on the investment side of it. Doug's going to cover most of that in his presentation today. I will note that the FY26 available to spend is reflected in this report. Now remember that is available to spend. We know for a fact that not all of those funds will be spent this fiscal year, just because the status of the projects, which will be touched on later this meeting as well. Because this was as of 3/31, the FY26 allocated amount is blank. We already have a handful that have submitted their application, so we will have a few of those that will be allocated by the end of the fiscal year. One of the things that we do need to cover, if you remember last year, we had one project that took an allocation. We had to approve an agreement, an MOA with the Economic Development Trust. We will be doing the same thing with both the City of Oklahoma City and the Oklahoma City Public Property Authority. More than likely, we'll look at a June special meeting to get those agreements in place because we still have a few things to get those through. The one thing I would note is a change in this month's report. The Innovation District is one of our projects that has two sub-projects, if you will, the Henrietta B. Foster Center and the Innovation Hall. What we've done is we created a line just to separate those out. As we discussed with the chair, we thought that was a lot easier to present. So this is the first time that the two sub-projects within Innovation Hall are presented separately on your report. And finally, we do have a new trustee, Christian York, the city's budget director, will be a trustee. He was not able to be here today, but he has gone through the training. We sat down, my staff and I sat down with him and went over the financials, went over the investments, went over the trust indenture, and so he will be ready to go the next time that you meet as a board. With that, I can take any questions you might have.
Any questions for Matt? Okay. If not, take a motion in a second to receive. Matt, thank you for your report. Please cast your votes. Okay, motion passes. Moving on to item 3B, receive quarterly investment report for the period ending March 31st, 2025. Doug, welcome.
Good morning, Madam Chairperson and trustees. Okay, thank you. Good morning. We're going to be going over the March 31st report and then an April 30 update. In volatile times like these, we need to remember that markets move a lot. And since this report came out, they have moved. Additionally, and I'll save that for what I think the returns have been since that time, but I'll tease it a little bit. They've been positive. So when we're going through this report, it is slightly dated, but I think the first quarter was a pretty decent lesson for all of us for a number of reasons. The first time that when we started the quarter at the end of last year, early this year, I would say that the theme of the market was American exceptionalism. The Magnificent Seven were unassailable, and the United States was the preeminent economy and equity market in the world, and the reserve currency. And then the first thing that really came up to put a dent in that overarching theme of the market was DeepSeek, the Chinese AI model that really caused a lot of folks to question the immense investment in both chips and energy infrastructure in the United States, because it did what these big LLMs, ChatGPT, et cetera, were doing at a substantial fraction of a cost, so much less costly. And if we remember last year, the Magnificent Seven, NVIDIA especially, were having enormous growths in revenue and orders, and all of a sudden that was caused into question. So we went into the first quarter. So in February, DeepSeek kind of broke on a Monday, and the markets went in kind of a temporary spin. And then the tariffs were announced, Liberation Day. And tariffs are a big deal. It is a substantial change to the international business community and operational. So we lived with that through the rest of the quarter, and as we see on the upper right-hand side there, U.S. equity market was down. The large companies were down 4.3% for the quarter, and something that is a little bit surprising to me, Russell 2000, which are small companies, those tend to be more domestically oriented, less export exposure there. They were down 9.5%. So what that told me is that the market was really probably not digging to the second or the third order of consequence of these issues, and were just selling what they felt was the most risky asset. Small caps are more risky than large caps. So U.S. equities were down. Now, something that I was pleased to see, that second, the gold columns and the brick red columns below those, diversification worked, right? International equities performed well, partially because the US dollar went down, and that helps translate the market value of your non-US dollar based investments. So that was important. We have some international equities here. The second order of diversification that worked were bonds, fixed income, which are traditionally supposed to ballast the portfolio when equity market volatility goes up. So those were both positive. So when we're in the first quarter of this year, it was not like 2022, which, remember, that was our first year investing this portfolio, and it was about as bad as it could get. equities down, US equities down, international equities down, and bonds down at the same time. So that was a positive takeaway from the quarter. If we look at trailing one-year returns, they're still positive, and this was as of March 30. April was also pretty volatile, but you'll see that domestic equity returns are pretty strong, with the exception of small caps. International equity, keeping pace with US equity for the full year period. And then bonds, you can see earning their coupon plus some more. That 3-month T-bill, remember, we have a large cash reserve here, about $4.5 million, which is about equal to the potential outlay. Allowable outlay is 4.6, we have 4.4 or 4.5, but that's all in cash, and we do that to shield it from market volatility. And you can see over the last year, 3-month T-bills were up 5%, which is pretty close to what your bond portfolio did at the same time. Now, this will potentially change, right? Interest rates may have to be lowered sometime in the future, and when that happens, when the Federal Reserve lowers interest rates, this 3-month T-bill yield will decline by about the same amount. So Federal Reserve says we're gonna lower interest rates over the next year by 1.5%. This goes from 5 to 3.5, and I don't think that'll cause us to completely change our cash holding policy, but we'll probably have to take a look at that as well. Well, I think it's a big way of saying is that cash is a pretty decent alternative to fixed income in the current yield curve environment, and we've taken advantage of that. So on the following page, you can see growth versus value on the US equity market, and growth really did take it on the chin, and most of that was in the Magnificent Seven. Again, Mag 7 is international companies, high-tech companies. NVIDIA was one that had a particularly harsh quarter, but also think about a company like Apple that does a lot of production in China and other countries in the world, and those supply chains are being reconsidered now. I think it's a nice way to say it. And we did have value stocks actually performing pretty well for the quarter, which brought them almost in parity over the trailing year. This is an interesting slide for one column. There are a lot of interesting slides on this, but for the trailing year, the Russell 1000, large caps on the upper right-hand side, the returns of the sectors that are listed on the vertical axis there, starting with communication services all the way down to utilities, and you can see their return for the quarter, and then the return for the trailing 12 months in the lighter blue of the paired columns there. And if you go to the very bottom, over the trailing year, utilities were up 24.5%, right? That's all utilities in the index together. And that's very uncommon to see utilities lead, but there was this interesting progression of events where utilities did very well last year because the United States is seeing generational electrical or electricity demand growth right now because of AI. So that helped them for the first 3 out of the trailing 4 quarters. But then in the first quarter of this year, it's a defensive, right? You're going to continue to pay your electric bill no matter what. So they had participated on the upside, and then they held during the downside. And when you see consumer discretionary and information technology down double digits for the first quarter. So I'm going to go here. So Apple on this, you can see on the upper left-hand side, this is the top 1,000 of the largest stocks in the US equity market. Apple, 6.4%. It was down 11% for the quarter. Again, we see the Mag 7 stocks dropping pretty significantly during that period of time, and NVIDIA down 19% during the first quarter, which brought their trailing one-year return to 20%. Remember, we've been in here recently and seen that one-year trailing return for NVIDIA at 150 or 200%. So that has cooled for the time being. And then I'm going to skip into fixed income. Fixed income was great during the quarter, and it was really nice in the year. If we're targeting a 4% return plus inflation, if I look at the bottom table, our fixed income allocation did not hurt us over the trailing year. It provided that 4+% return that, frankly, I'd like to see. I don't think we're going back to zero interest rates anytime soon. So fixed income will actually help us in times other than severe bouts of market volatility. Yes.
Quick question on that. The recent Moody's downgrade, is that going to affect this at all?
Hard to tell. Last time that the U.S. Treasury was downgraded, a month later, Treasury prices were higher. And just remember, if even the U.S. I'm going to try to crystallize this. If the world's strongest currency and one of the world's strongest economies that has a printing press, if they're downgraded, everything else has to be downgraded at the same time, right? So,
Printing press.
yeah, that's good to have, right? It's very useful to have. I think it's, in credit rating agencies, I say this through the lens of a multi-decade career. I remember that before Lehman Brothers defaulted in 2008, I think they were rated AAA 2 days before. So they're not always the best indications. They are an indication of credit quality, but I don't think that they're always the best. Good question. It doesn't mean that, you know, we're downgraded and rates. I haven't looked at the rate market this morning, but I wouldn't imagine that they're much higher. It was attention-getting, I will say that. You don't see sovereign nations downgraded very often. So here's where Matt described this in other terms just a moment ago. Our market value at 132.9 at the end of the quarter. At the end of April, it was about the same. So our strategy has done well. You can see that since inception, we have had gains of $17.7 million versus very small distributions. Again, these are capital projects, and they're not ready for maintenance or investment in operating funds. And income is $9.4 million. So that's a pretty decent gain, especially considering where we started. That first year was very rough. But the gray area there, that's the corpus. As long as we're above that, we're able to make. And that buffer, we expect to gradually grow over time. We're sensitive to risk here. This is our asset allocation. This is pretty interesting. We started 2023, and you can see that we reduced equities and we put it in cash. And that was a tactical move. And I think that early in the stages of this, it definitely helped. So we are pleased to do that, and if we have an environment where something similar to that happens, we have similar circumstances around the world. I'm not saying we're in one right now, but we'd have to consider it. I think so. I think that with a pool of capital like this, I think it's perfectly prudent to increase risk and return capability gradually. But if you need to reduce risk, you should probably do that quickly, right? They're two different environments would produce those actions. Here's our asset allocation. Total equity, you can see, is 46 plus 8, and then the rest is in fixed income and cash. And this is our, hang on here, this is our allocation amongst the individual assets. Very streamlined portfolio, very cost efficient, and one that's working pretty well. You can see here that our fixed income composite appears to be over. That's because we have not allocated to alternatives in real estate. I'm still very negative on real estate. I think that there's a lot of changes to be made, and until we start seeing some light at the end of that proverbial tunnel, I think better part of courage is discretion, and until we see something that's positive out of that, just continue to hold off on that allocation. And remember, we're investing, we're putting where we might be invested in alternatives in real estate in fixed income. So it's very, very low risk. And I think it's a prudent way to allocate that capital. Other than that, you can see everything is right on the center line of the target allocations. Income appreciation was negative during the quarter. You can see that it was in our equity portfolios and our high yield fixed income, which is about 50% fixed income, 50% equity, the way the returns work out. And then over the trailing 1 year, started with 125.5 million, income of 3.9 million and appreciation of 3.7, yielding that end of quarter market value, and then distributions very, very small. But again, this trust is meant to fund those projects at the bottom, and we need to keep that in mind when we're making decisions. Here's the total fund. So during the quarter, down 0.4%. For the trailing year, 6.04. And we had a 3-year return for the first time ever, 4.21. So we have made up the ground that we lost initially, and we are starting to compound returns. If we look down the trailing 1-year return, more positives than negatives. The index equity investments, the domestic equity, all track their benchmarks very closely. You'll see that small caps were down slightly and large caps led the way. If we go into the international equity, positive return on the quarter. Again, this is diversification. This is why we don't put everything in what we think is going to be best, because we usually don't know what's going to happen. And that's, yes?
Can we go back to the slide where we showed the income?
Of course. For this one?
Yes. What I really like is how you break out. We don't always talk about the income versus the appreciation factor.
Yes.
And that really plays in, because you look at, on the fixed income, I guess you need to turn the microphone on.
I do.
Thank you. So I just think that's really a good way to just show that, we're not only do we look at it from appreciation, but we did bring in a significant amount of income during that time period as well, so.
Right. $2.5 million over the last year, just from 2 fixed income portfolios. And then the cash, $222,000. Again, we operated in an environment where cash paid nothing for almost a decade, and here we are where it doesn't really penalize us as much as it once did. The transfers look big, right? But that was just investment of the inflows into the trust.
Yeah.
And you can see most of those went to fixed income. It's our largest single portfolio. So does that answer your question, Brent? So looking at our international, and this is an index fund again, it's meant to track the ACWI World ex-US, 5.58% for the quarter, so good diversification there. You can see over the last year, and it's starting to keep pace with domestic equity, but over the last 7 years, we don't have a 10-year figure for this, substantially lower than U.S. equities. And talking to international equity portfolio managers, the valuation on non-U.S. stocks is substantially lower than U.S., which means lower risk, potentially higher return, and again, positive diversification. Our fixed income has done well. You can see that for the quarter, up 2.87. Again, risk-off environment. People sell stocks, they buy bonds, and this portfolio is well suited for that. Over the trailing 1 year, 5.5%, 9th percentile. And then our high yield fund, you can see 8.15% for the trailing year. And I really like to look at the since inception. This is since inception of the funds, not the trust. And as we go down that list, it's been a real tough time to be an active equity manager and outperform indexes, so we're going to take advantage of that. You can see that the ranking on the international index is a little bit lower across the board, so maybe that's something that we start to talk about this year. I feel like we've had some stability, potentially complement or replace the international equity with active management, because those have the ability to outperform. Remember, I think that a lot of this portfolio, it's step 1, step 2, step 3. I would say international equity considerations are going to come before the alternatives in the real estate, just because of where we are in the cycle. And then our 2 fixed income portfolios, again, they're different. Dodge & Cox is core, first percentile since inception in 1989. And then the PGIM high yield, 6.23% annualized 24th percentile. So that is the very high line of the portfolio. It's doing well. I was pleased to see that during the quarter, because of our diversification strategies, our return was a modest loss. And then if we look at the other 2 full-year periods that we have, we've been well above the spending rate, which is what we're targeting here. Do I have client portfolios that have significantly more in equity? I say, yes, I do, but they're considerably more mature. And as we continue to build that buffer of market value versus the corpus, we can do that over time. But philosophically, again, I'll repeat it, increase risk gradually, decrease risk immediately. If you have that, if you're in an environment where risk is something that's going to be punished, then act quickly like we did in 2023. So these are the slides that I will allow you to cover at your own time. And I will say that this is very important. So as fiduciaries, one of the things that we really have to watch out for or pay attention to are costs. This is the investment management expense of the total portfolio. For a $133 million portfolio, 20 basis points is very attractive. And a lot of that's because our domestic equity is very inexpensive. 1.5 basis points, 5 and 5 basis points, and our international equity at 6. International equity tends to be closer to 1%. So that's the barrier that we have to overcome if we're going to be moving it to active. And then our fixed income, this is a little bit unusual. Our fixed income expenses are higher than our equities, but that's because those are actively managed, and both of those portfolios are demonstrating that has been money well spent.
Doug,
Yes.
what period of time did that cover? Is that for a year?
That's 1 year.
Okay.
Yes,
Okay.
yes. Thank you for that question. So you can see that the investment management expenses in dollar terms is $270,000, which is not a small number. And it's interesting, again, this portfolio being all passive on the equity side, your biggest management expense is for Dodge & Cox, your core fixed income portfolio, which that's not generally what happens, but I am going to flip back to their slide here. You can see over the past 2 years, these are net of those fees. And you'll see that over the last year, they outperformed net 553 versus 488, 12th percentile, right? So they justified their expense that year. The last 2 years, 481 versus 328, right? That's more than 150 basis points, 160 on average over those 2 years, in 4th percentile. So I'm okay with that expense because they are proving it, that they're worth it. And so with that, we don't have any managers on the watch list, which is great. Everybody's doing their job. Diversification worked during the quarter, and the portfolio remains in positive terms. The most important thing, are we above corpus, and are we producing it better than 4% per year? And since we've started this, we have, definitely. So I'm happy to take any questions.
Any questions for Doug? Any additional questions? Kevin?
Doug, do you think that the actively managed funds sort of being out of favor is more of a trend because the indices are performing so well, or do you think it's a paradigm shift in that people are preferring index funds because they don't believe active managers can consistently outperform?
You're asking me to speak for it.
Just your off the record opinion.
We're
off the
definitely
record on the record.
yes.
Off the record on the record.
Yeah, these lights and the cameras tell me this is on the record. So over the course of my career, I've seen it both, right? I've seen periods of time where active management has performed well, and I've seen periods where passive has beat the pants off of active management. And you can also say, you know, the value stocks versus growth stocks, right? That's kind of plays into it also. Where we are right now, the cap-weighted indexes are very tech-heavy, right? And it feels a lot like when the internet bubble happened many, many years ago. And for us to transition into an environment, this is in the past, for those stocks to fall out of favor and other stocks to take over, it usually takes a pretty significant economic downturn, right? I would say that one of the greatest things about passive management is that it takes a lot of burden off of you and me, because we have exposure to the marketplace, and we're not going to second guess it as much. And sometimes it's worth it to subject yourself to that. Like fixed income is something that I never advise my clients to invest passively in fixed income because that market index is beatable. These other indexes, the U.S. large cap index, it's going to take a big change to convince me that it's worth our time, effort, and expense to go active there. So I think, and I'm not alone in that. I know a lot of my colleagues, field consultants, feel the same way. Let's just set that in an index fund. It'll track, and we'll try to add value at other places where it's a much higher probability and better use of our time. So international equity, that's where we are. As far as indexing mid-cap and small-cap, I tend to be open to either approach. But where we are right now, I said it earlier, I think we should look at international equity, at potentially complementing or replacing the index fund there, because I think it's beatable. There are more factors where managers can beat the index.
So international fixed income, maybe even private markets at some point?
Oh, you have to be active in private markets. There's no. But as far as large cap U.S. equities, I'm not going to waste your time, because those tend to be, we're just going to hire somebody 5 years down the line. We're not going to be super happy with them, so we're going to have to go through the whole process over and over and over again. So from a cost and time, it's just hard to see that it's worth it. And I would say that going into, so there are other products that say that they're index plus, right? They match the index for most of it, and then they try to add a little bit of value at the edges. And I don't see that that's worth the time either. I mean, you're spending significantly more money for a little bit less. You're not getting truly active management, but you're paying, more active management than passive fees. So, again, I don't, if we have a substantial if we have a recession that lasts 2 years, probably be looking at active, just because the opportunities that arise in an environment like that are different. And I know the Wall Street firms earlier, they were saying, yeah, we're at least 50% recession this year, and they've backed off of that. They're saying more like 30%. And remember, the yield curve was inverted for 2 years straight. And that's supposed to be like the best predictor of a recession that is on, and we still haven't had it. We're still waiting on that one. So again, I don't think it's worth it for us to spend that time on domestic equity indexing. I think that there's so much flow going to index funds, either through just normal investors or probably something that's not widely known enough. If you're in a defined contribution plan and you're in a target date fund, every 2 weeks you're probably giving money to an index, and that's going to, it's not classic investment finance academic theory, but the more money you have going into an index, the better and more stable it's going to perform. So that was a very long, rambling answer.
No, it's good. Thank you for that.
Yeah.
I think about this a lot. So.
Good. We want you to.
Thank you.
Any other questions for Doug? Okay, do you want to go ahead and present April?
Perfect.
Okay.
There we are. So April was another interesting month, I'll say. Equities were down marginally. I saw somebody say that at the beginning of April, S&P was down 12%. and then it came back 11%. And for the first quarter, or for the year to date through the end of April, the S&P ended almost exactly where it started the year. The same with interest rates. And the sarcastic side of me said, you know, nothing's happened. It's been a boring year so far, but it's been anything but. Remember that when the market goes down quickly, it tends to recover quickly on the other side, and it happens very, very close to those deepest drawdowns. So that's why we stay invested. And as we look at the portfolio, not many changes to the allocation. For the month, down 0.68%. For the year to, for the month, down 10 basis points. For the year to date, down 50 basis points. Trailing year, we're still at 9.26%. I would say in the trailing month, equities, the month from today back, U.S. equities are up 7.5%, 8%. International equities up low double digits. And fixed income has continued to be pretty stable. So this shows us where we are at the end of April, and I don't know where we're going the rest of this month or the rest of this year, but this is a very strong portfolio structure, and it has produced what we intended it to, despite some pretty trying times. There was one day, I believe it was in April, where it was the day that the 90-day extension or the 90-day pause on the tariffs, the U.S. equity market was up 12% on that day.
Yeah.
And I have to tell you, I'm always conscious of recency bias and saying, you know, and I, like I say, I think about this a lot, but on that day, I was in my car and I was talking to somebody and I said, oh, did you see the market? And I was like, no, and the person said, it's up 12% today. And in my mind, I was like, that's the biggest one-day percentage move I have ever experienced. And then I went back to my office and I looked, no, we've had 3 days like that in the past decade. So even I am struck by some of these recency biases. And you need to keep those in check, which is why we have policy and why we have a long-term allocation. So that is the story as of April. And I'll take any questions.
Any questions about April's report? Okay. Did you have a question? No. Okay. So first off, I just want to thank this board for your wisdom and tolerance of doing the deviation that we did in 22-23, and I think we're seeing how that's played out for us. But we could have easily said, no, we're just going to stick with our policy, and we wouldn't be in as good a shape as we are. So I want to thank you for that. So no questions for Doug. So we need to both receive the quarterly report ending March 31st. So we'll take that vote first. Okay, that motion passes. We also need to vote to receive the monthly investment reports for February, March, and April. Okay, that passes as well. Doug, thank you so much for being here. And if you could predict the future, you would be on your island and not with us today. So, but appreciate all your guidance.
Thank you.
Okay, moving on to item 3D, approval of the fiscal year 2026 annual budget, establishing revenue and expenditure budgets for July 1st, 2025 through June 30, 2026. And I believe we have Nicole Tower. Okay, Nicole Tower from Budget will be here to present.
Thank you. Okay, so I'm Nicole Tower from the Office of Management and Budget, and I'm here to present the FY26 Accommute budget. So you can see here on this, go ahead. On this slide, our estimated revenues for FY26 is $5.15 million. Next. And the expenditures, you're probably used to seeing this list of projects, but this is based on the 4% fund distribution you guys approved last time. Okay. Happy to answer any questions.
Hey, any questions for Nicole? Short and sweet. Any questions? Okay, if not, I'd take a motion in a second to approve. Nicole, thank you. Okay, Okay, the motion passes. Well done. Moving on to item 3E, ratify claims from February 12th, 2025 to April 15th, 2025. And there were 5 claims totaling $50,690, and they were for audit services, investment consultant, and the custody bank. Any questions? Okay, not. Those claims are ratified. Thank you. Okay, and finally, moving on to item 3F, we asked David Todd to come and present kind of an updated current status on all of the MAPS 4 projects. We thought we'd talk about them, but I thought it'd be helpful for you all to have a little more context about those projects. Welcome, David.
Good morning. David Todd, MAPS Program Manager for the City of Oklahoma City. I have with me Carrie Medley and Todd Woodward. Todd Woodward's the Assistant Director. And Carrie helps us with all our presentations and all our
Technology.
legwork that we have to do here. So glad to be here today to talk to you about what's going on with the program. I'm going to give you just a very high-level, quick summary of what's going on today, or what's going on with the program today, because otherwise we'd be here for a couple of hours, so I don't think you want to do that. Remember that there's 6 subcommittees, and then within those subcommittees, there's 16 project groups. And then as you split that out into the various projects, there's about 95 projects that we're managing right now within MAPS 4. We'll start off with Civil Rights Center. This is Clara Luper Civil Rights Center, named in her honor. $17 million for that Clara Luper Civil Rights Center. We have the operator on board, that is the Freedom Center, and then we also have architect that's been working on that. Preliminary report is going to council tomorrow, so subcommittee and advisory board have seen the preliminary report, and as I said, it's going tomorrow to council. This is what it looks like, an early rendering there. It's located right near the Freedom Center between 24th and 25th on M.L. King. I might add, feel free to ask any questions as we go along here, because you might forget your question by the time we get to the ending. So community has the Diversion Hub, the Family Justice Center, homelessness and mental health within it. I'm sure you're familiar with the budget splits. As far as homelessness, we have 5 $11.5 million allocations to give to the Oklahoma City Housing Authority. We have executed 2 of those, and they have been working with some renovations, with some new construction, and also some purchases. This is just how it was lined out, that we would leverage that $55 million into about $460 million, maybe $550. But that's the goal, is to take that money and leverage it with loans and tax credits and other investments like that. So as I said, we have 2 of those that have been sent to the Housing Authority. Diversion Hub is located on Linwood Boulevard. You know, Diversion Hub is an active organization right now, and this will be a new building for them. And we are under construction right now, probably been under construction, I think 3 or 4 months. This is the general site plan for that building, and there's the rendering for what that building will look like. They've got most of the structural steel up, but the weather has really slowed us down recently. But when it's finished, that's what it will look like. We anticipate it being finished about a year from now. Family Justice Center, we just had our groundbreaking on that last week. It's located there at that orange box right across the street from the existing Palomar. And this is the rendering of what that building will look like. It's 3-story, about 70,000 square feet. Some interior shots of what that building will look like. This is a general meeting area and community room. And then the office space, which is the core of what they do. Mental health has a crisis center, restoration center, and supportive housing. Also tomorrow will be the preliminary report for the crisis center, and this is what the crisis center will look like. So crisis center is a facility that supports people for up to 24 hours in one way and then maybe up to 2 weeks in another manner within this building. Supportive housing, we're still looking for the operator for that. Remember that MAPS has operators with nearly all of the projects, and they're crucial to how we work and how the facility works after it's completed. So we'll have another RFP going out for a operator for the supportive housing. Seem to have missed the restoration center. The restoration center is in design also, and preliminary report will be coming out in a couple of months. But the restoration center is essentially a crisis center along with methamphetamine detox and some other services, addiction type services. And it will be adjacent and somewhat connected to the supportive housing. Connectivity has several projects in it: the beautification, transit, and then sidewalks, bike lanes, trails, and streetlights. Beautification master plan is going to council tomorrow also. The beautification plan will just do little splashes of beautification across the city in many locations. So they're not complete streetscapes, but for instance, there'll be a garden in the honor of Bessie Coleman, who was the first African-American aviator who was from Oklahoma. There'll be a garden put out at the airport. Some of that might help with the way the gateways look on I-40, I-35, those places where people come into Oklahoma City. They need to know that they're coming into Oklahoma City. So that's how beautification works. Transit has a whole lot of pieces in it. The two main parts of the transit project are the BRT. You know, the city just opened the Northwest BRT. MAPS has a BRT that will go northeast and one that will go south. Both of those routes have been determined, but design has not yet started because, as you're well aware, that MAPS being a pay-as-you-go program, we have to wait until that money's available. The other big part of the transit project is all of the bus stop shelters that we're putting in. We've put in about 150 to date, new pads, new sidewalks, and new structures. And then sidewalks, bike lanes, all of those are underway. We have 2 sidewalk projects in construction. We just bid a 3rd one, and we've got 2 more in design. So a lot of sidewalks going on. 2 bike lane projects under construction right now. We just selected an engineer for the trail project, which will connect the May Avenue Trail that Public Works is building from Woodson almost, well, down to Southwest 59th Street. We will take it on down to 74th Street, and then this MAPS trail will go 74th Street all the way down to Earlywine Park. Streetlights, we're working on a strategy for those, but all of that is actively underway. Innovation District, Innovation Hall has been completed. That was a program where we matched with the developer over there, gave them $11 million, and they did the actual construction, but that is open right now. Connectivity is a project that is underway right now, and another one is being advertised. It's in two pieces. That is sidewalks and the amenities that were taken out of that area when 235 was put in, and just as the area just deteriorated, we're putting in new sidewalks and new wheelchair ramps and lights and all of those things. And this is in that innovation area, which is roughly 23rd to Reno and I-235 to ML King, roughly in that area. And then the H.B. Foster Center sits in that area. It's at 4th and close to I-2, or Lincoln, actually. That's a rendering of the renovation for that building, and this also goes to council tomorrow as a preliminary report, and we hope to have construction started by late summer. This is a minority business incubator project. Neighborhoods, we have senior wellness, animal shelter, all the parks, and the youth centers. So youth centers are not going to be the youth centers that you're used to seeing. They're not a pool and a gym. They provide spaces that up till now were not typically seen in an Oklahoma City Youth Center. We have the Boys and Girls Club as our operator, and they are already doing some of these things in their facilities. So what you see up there is spaces to provide mentoring for kids, helping with homework. There's some STEM type activities, even if kids just want to play video games, just to keep them off the street and keep them busy. There'll be spaces for all of that. The slide says next steps. We've actually completed the location, site location activities. So the 4 youth centers will be at the existing Boys and Girls Club at 36th and Prospect Northeast. Then we'll put one at Melrose Park, which is at about 10th and Council in that area. There'll be one in Woodson Park, which is at 29th and May. And then we're in the process of purchasing a church at Southwest 68th and Santa Fe. And that will be a renovation project. The Parks Master Plan has been approved, and we're starting the first section of plans for that. 107 parks were looked at. These are neighborhood parks. This isn't Lincoln Park and Will Rogers Park. It's the smaller parks that you see within your neighborhood. So 107 of those parks were looked at by our consultant for completeness and conditional assessment. And the goal was to bring each of them up to equal completeness and equal conditional. So this would take me an hour to explain everything they went through here, but they did analyze each of those and trying to bring them up into that pink band that you see in there. So those will start real soon, and you'll start seeing some improvements in parks before the end of the summer. Animal Welfare Center has started. This is at the existing site at Southeast 29th and Bryant. That's the facility here down in the left corner, and then the new facility will be north of that. Lots of space. It's about 2.5 times of what we have for an existing facility. It has a full animal clinic in it, offices that they don't currently have there because of the expansion that they've done within the building. Some renderings of what the welfare center will look like. See, there's separate entrances for intake and adoption, and then clinic over there on the right. This is an area that they don't presently have, and this is where people can find the dog or cat that they want to adopt and actually interact with them out in the open and see how that works. And this is the entry to the lobby. See, it's very bright and very inviting. And the cat habitats, and then the dog kennels. This is all state-of-the-art with noise reduction, odor reduction. And then last is the venues subcommittee, which includes the downtown arena, the Fairgrounds Coliseum, and the multipurpose stadium. You can see the breakdowns there. The multipurpose stadium is in design. We should have preliminary plans within the next couple of months. I can tell you that that picture is just a picture. It is not going to look like that. But it's just my placeholder in this presentation.
David, where is that going?
What's that?
Where is it? The location?
Yeah.
At the multipurpose?
Oh, the location will be the old Producers Co-op area. The developer of that area has donated the 9 acres. The furthest south up close to the highway is where it'll be, right in the middle of a new development happening there.
Yeah, it's going to be a great location. Yeah, it is.
Paycom Arena, as you know, we're building a new arena, so most of the money was taken out of this and applied towards the new arena, but there were some updates that we had to do to keep Paycom Arena functioning for big games like yesterday and the upcoming games that we're going to have. So all the seats were replaced. You know, seats get old, they get used, they get beat up, and they get to where you can't even get spare parts to fix them. So we replaced 18,000 seats in there. We also did, we replaced the scoreboard, as you've probably seen. We replaced elevators. We did some other things to help keep the facility up to the level that's expected for, at the time was, you know, the next 5 years before the new arena opens. And then the Fairgrounds Coliseum is the project that will finish first within MAPS 4. We're less than a month, we're 2 weeks away from opening this project. There's a nice blurry picture of it. But it's progressing well. The inside, these pictures are about a month old, but the inside will be just state of the art. The inside will also see things within the Coliseum that you don't see out there now, which is really top of the line concessions and amenities that don't exist now. So that was my quick run through with where we are on everything. If anybody has any other questions.
Questions for Mr. Todd?
I really don't have any questions. I just wanted to tell David and Todd and Carrie how much I appreciate all his work. I've been working closer with him here in the last couple of months, and this guy has to herd a lot of cats.
Oh, yeah. Oh,
And
yeah.
he's got a lot of people he's got to try to make happy too. So I commend him for his work that he's been doing, his efforts, and thank you.
Yep, thank you.
You have a great office, tell them all thank you, but you're a great leader. So, any other comments?
Okay.
I will say, of all the groundbreakings that I've ever been to, the animal shelter was so much fun because we had dogs in hard hats and shovel. It was the best. It was absolutely the best. But they're all great. They're all great groundbreaking days. When
But
we
it
get
was
to
the
that
most
day,
fun,
yeah,
yeah.
it was the most fun. When I walked in, they were playing music that I was due, and it was Who Let the Dogs Out. And I was just like, this is going to be so much fun. This is going to be great. So thank you so much for coming and
Okay,
sharing.
thank you.
Thank you. Okay, so moving on to item 3. Moving on to item 4. Any comments from the trustees, staff, or interested parties? Do we have anybody sign up to speak today? Okay. Any comments from the trustees or staff? Okay. So that brings us to item 5, adjournment. Thank you so much for being with us today.